Hello everybody, welcome to Online Trading Academy's annual webinar talking about the top 4 events that may be impacting your upcoming year. Of course, we know there are many events going to impact our markets, but there generally are a grouping, a cluster of them that are significantly impactful. We'll try to address those 4, and they may differ from yours. So what I would encourage you to do is go ahead and type in your chat what you think some of the top issues facing our markets will be. I already see we've got a couple coming in here. So Paul and Ruben and Gayer, welcome. I know we've got a bunch of people out there, so make it interactive. When you guys see me looking down, I'm actually looking at your chat as we go through here today. So apologize if you see me looking down sometimes. No worries. This will also be recorded, so for those of you who have friends that may not be able to join us, you can share this with them later on. All right, so we do this every year. It's kind of become a tradition here at Online Trading Academy where we go through and look at those 4 components which may impact our markets going forward. We did it in 2018, 2019, and of course today is all about 2020. But before we dive into 2020, let's take a quick look back at 2019 to see what those issues were and maybe a little bit of a review to see how they came to fruition or what was the impact of them. So let's start off with those 4 that we looked at back in 2019. Number 1, see the presidential buildings here. Now that was really just politics. That wasn't anything to do with election. It was really the political structure of the United States was a mess. There were so many different things from immigration and trade and taxes. We felt that was going to be a major one, and I think that we could all agree that that was a major player in what happened in 2019. Also, number 2, you had the interest rates, and we'll look at that here in a second. We had number 3 was our Brexit, which of course is a global fiasco that we as Americans love. Why? Because it makes us not look so bad. We seem to be the laughing stock of the world in many times, but right now we can point over at the UK and go, at least we're not going through the Brexit, which is still going on, by the way. And finally, we had the trade war, which we will look at today. It's still a component for 2020. Obviously, it's escalating, but it's taking a different turn. And I have some very interesting visuals and numbers and facts for you that you're going to be like, wow, I did not know was impacting those assets. No matter what you are or who you are or where you are, it is going to impact you one way or another. So those are our top 4 for 2019. Let's see how some of those panned out. First one we want to look at here is the Fed Funds Reserve rate. Now, you can see back in 2018, they were aggressively cutting, right? And we needed to bail out our economy, bail out our markets, and we went flatline to the better part of, let's call it 6-7 years. Then all of a sudden, in late 2015, we started raising rates and slowly doing so. But you can see they were raising and raising all the way through late 2018. Now, that doesn't necessarily mean it's a good or a bad thing that they were raising rates. I believe they should be raising rates because it gives us a little bit of a cushion to manipulate our currency and markets going forward. But what happened was most other countries didn't do anything. They actually were cutting as we were raising. So all of a sudden that puts undue pressure on us going forward. And you can see that we've had 3 rate cuts in 2019. When we came out yesterday with our announcement, of course, they said they're going to stay right where they're at 1.5 to 1.75, which was no surprise. What's really interesting is what this will look like for 2020. Right now, the Fed has said that they plan to stay the course and not raise or cut in 2020. Of course, the markets think a little bit differently than that, and maybe we can get to that a little bit later on. The other piece that was interesting with regards to 2019, of course, was the Brexit. Now, there was a lot to do with Brexit, having to do with trade and political structures and tariffs, all that stuff in the EU. But most importantly, you see currency charts. This is the Euro British pound. So for those of you who don't trade currencies, this is really buying one currency and selling the other. In this case, you'd be buying the euro and selling the British pound. Point is, there is extreme volatility in the euro, in the British pound, and it was an incredible opportunity for those people who are trading Forex markets, big pip moves, and of course a lot of opportunity. Why? Because in the Forex markets, there's a tremendous amount of leverage. Here in the US, you get 50 to 1 leverage. Internationally, for those Europeans we might have with this, you could get upwards of 500 to 1 leverage. Of course, we know that that's a very double-edged sword. It can be very, very dangerous if you don't know what you're doing. So if you don't know how to trade Forex, get educated first. All right, that was just a quick little review of 2019. That's in the past, right? We only got a few days left here in 2019. So let's move on to what we see happening for 2020. Now, it's going to be a different year. We've got some different animals to contend with. Now, if we look at the first one, right away, I think we'd all agree that the election is probably the most important thing. We've got the election coming up in November. That will be a big part of it. The second piece that we're going to look at here looks like interest rates, but it's not. This is actually the bond bubble. Many people within the halls of Online Trading Academy feel that we are setting up for the perfect storm. What I mean by perfect storm is we have an equity market bubble. If you don't believe we're in an equity market bubble, just bring up a chart of the S&P since 2000 and actually go all the way back into the 80s and look at this most recent move from 2009 through right where we are today in 2019. It's been a decade of unbelievable gains fueled by manipulated currencies, interest rates, and bond markets. So that bubble could burst any moment. Trifecta. You've got an equity market bubble. We have a housing market bubble. Of course, not every market has had a bubble, but in general, as a whole, the U.S. economy has had a housing market bubble. And the third one is a bond bubble, and I'll show you that here in just a second. That is a big one. And if those three things collapse, we could be in a world of hurt. The other part here is what President Trump keeps talking about, the currency war. Yeah, that's right. These other countries are starting a currency war. Well, let's be honest. It's really us that started the currency war, and we will probably continue that. I'll give you some facts and figures here to back that one up, but that is a major issue going forward in 2020. And finally, we have the trade war, or shall we say an escalation of an existing issue that started in 2018, really. It's been getting bigger and bigger and bigger. I still haven't, from a market perspective, felt the pinch that I thought we would see with regards to rising prices and inflation, but either way, it's going to be a big one that will impact all of us, and I'll give you my 2 cents on that one going forward. So let's start off with the first one, which is the elections. I think it's no surprise that presidential elections can have a significant impact on our financial markets, both good and bad, right? It depends on which candidate gets elected. So let's start off with the very, very basics. We have, to start, what happens if the Republicans win? Now, of course, we know right now President Trump is the president, but there's no guarantee he will remain there. You know, Michael Bloomberg just jumped in the mix, and he has a lot of popular supporters. So we may even get a change if the Republicans win. So it really becomes down to what are the issues that would generally benefit, or what market segments would benefit from a Republican win. First one we want to look at here would be big banks. Republicans have always been pro-big banks. I think we could look at most of these big financial firms and know they're going to get support from the Republican Party should they win. Second one here, energy. Now, I say this with a big asterisk because when you think U.S. energy, you guys are going, oh, the Bakken shale, right? I'm going to go natural gas and all that stuff. Yes, but there's other areas where they won't be supporting. Historically, Republicans are very big on fossil fuels. So those of you looking for, the trans pipeline and drillers and refiners, those will probably do rather well. There's one ugly energy source out there that's historically powered America and many parts of the world that has the wonderful oxymoron of clean coal. Coal was big under Republicans, and President Trump said that he was going to roll back a lot of regulations, which he did for coal in 2017, 18, and 19. So depending on who's elected, Republicans will probably be good for fossil fuel base. Not so good for alternative energy, not so good for wind or solar or things like that. So just keep that in mind. When I say U.S. energy, that's not everything. That's a specific grouping. Now, as you are watching or seeing who that candidate may be, let's say it's Bloomberg and Trump are the Republican favorites. Obviously, Trump, I think, is the favorite at this point. But if Bloomberg gets in there, he may have a specific market segment that he is interested in. Who knows? Maybe, I don't know his personal background right now, but maybe he is more interested in alternative energy. Then you might want to steer your investments there. So you kind of want to understand the candidates going forward. All right, defense. Come on, we know Republicans, more planes, more defense money. Let's take away from social products and services and just buy more airplanes and tanks. So Lockheed Martin, Northrop Grumman, these types of companies will probably do or continue to do rather well under a existing or continuing Republican Party. And drug makers. Historically, drug makers have also done rather well under a Republican Party. Now, let's face it, why have the markets done so well? The markets have done so well because we've had much less regulation and we've had tax cuts. That is a hallmark of Republican Party. So if that were to change, obviously this could create a big change in dynamics of where these markets may head. If it stays the same, enjoy continued lower taxes, and you could also enjoy less regulation. All right, we saw a resurgence in coal, which just shocks me personally. Coal, come on, we can't figure out anything better than coal, but it does create jobs. It is a fuel source. That might change if we get a Democrat. All right, so I see Pierre's laughing at the Bloomberg. Hey, there's all kinds of crazies out there running. I don't know if he's good or bad at this point. All right, let's flip the script and go to if the Democrats win. I'll make a blanket statement right now, which might freak some of you out. It's not just that the Democrats would win, it's who in that Democratic Party would win. I think right now you have the favorites are going to be Joe Biden, Bernie Sanders, or Elizabeth Warren. Now, I don't want to mention my thoughts on either one of those, but there is a general belief that if one of those three names was elected, it could be catastrophic for the equity markets. And I think, maybe not catastrophic personally, but I think it certainly would have a big downturn. Why? Because if you have Democratic victory, most likely we're going to see some of those tax rollbacks removed and taxes might start to increase. There'd probably be more regulation on specific market sectors. So a lot of these fossil fuel companies, which Republicans were really supporting, they may feel the pinch. You might see coal just get a slap in the face and shut down. So there could be big changes here in specific market segments. Now, let me just real quickly give you a figure that I was reading going back to Roosevelt. Was it Roosevelt? I think we'll go all the way back to Herbert Hoover in 1929. If you go all the way back to Hoover in 1929 and look at Republicans versus Democrats over a 4-year administration, who has a greater annualized rate of return under their administration? This is shocking. I'm a finance graduate, so I studied finance, and my belief would be that Republicans would have a way better positive impact for the financial markets. They're pro-business, less regulation, less taxes. That's more money for the markets. Let's grow, grow, grow. If you look at the rate of return going all the way back to Herbert Hoover in 1929 through, I believe the number I finished on was Obama. I don't think it had Trump in there. You're looking at an average annualized return of 1.71% for Republican administrations. Annualized, meaning so each year of that administration. What do you think it is for, and you go ahead and type this into chat. I'm really curious to see what you guys think it is. What do you think it is for the Democrats? If the Republican Party was only doing 1.71% per year under their administration, what do you think the Democrats are doing? You know, right? I'm pretty sure that most of you would probably look at this and go, well, Republicans are pro-business. You know, they're going to be less regulations. That's easier for more companies to start up. That's jobs. That's economic boom. And that's kind of what my belief system was when I was in college as well. So what do you think it is? Type it in the chat. What percentage per year do you think that the Democrats have achieved while the Republicans have only achieved 1.71%? I'll give you guys just a second to that one. All right. Drum roll. The answer is 10.83% annualized rate of return under Democrats. I found that rather shocking because you would think that if you have higher taxes, if you have more regulation, that would contract or constrict economic growth. And the numbers don't lie. You go back historically, you can look at those and see that the Democrats under those administrations have had a much greater annualized rate of return. Interesting. I see Dave saying 0.5. I see Dwayne saying 3.4%, doubled that. Yeah, I thought it might be close. It was an absolute blowout. What I'll do is maybe later on, I'll go grab that image for you guys and I'll post it so you guys can see the whole breakdown of each administration, but I didn't include it in the presentation. So with that said, let's go into the Democrats. If the Democrats win, I'm making broad brushstroke generalizations here because, again, if you have one candidate versus another win, it could be dramatically different what country or what economic segments might benefit. Number one, I think we would all agree, infrastructure. And this isn't just Democrats, or I think this is Republicans as well. I think that there is a growing interest on both parties right now to say, let's create jobs domestically by building infrastructure. Now, some might differ on what that infrastructure is. Some might think that building a wall across our southern border is the way to build infrastructure. Others might think it's doing railroads and high-speed trains and things like that. But right now, I think Democrats are keen to build more infrastructure products. Alternative energy. This is the big distinction between that Republicans and Democrats. What's crazy about this one is you'll see if a Democrat's in there, my guess is much more regulation on coal and oil and maybe even natural gas and fracking, those types of things. But they are very pro-solar, alternative energy, exploring new ways to generate sources of energy. So that would be a great resource or a great area to focus on if we get a Democratic victory. Another one's transportation. Why is this one important? Because if you listen to the candidates recently, a lot of them have been commenting on transportation. All of them, 100% of the Democratic candidates all said that they feel that Americans should be driving electric vehicles. I found that to be surprising. That means that there's going to be this push towards transportational change. Does that mean we all have to be out there driving Teslas? But no. But does that mean that Tesla might get a boost from this? Sure. I believe if the number I read was like there's 1 million electric vehicles on the road and over half of them are in California. Well, if this spreads and it becomes more of a governmental issue, we might see that spread across more states, and all of a sudden electric vehicles, companies like Tesla could potentially do very, very well. It doesn't stop with cars, though. the conversation has been a lot of high-speed transportation, moving into electric trains, maybe changing our existing infrastructure to accommodate different types of vehicles that are not using fossil fuels. So that would be an interesting area for the Democrats as well. And finally, healthcare. We all know we want to go to universal healthcare, and that could be a big boom for healthcare. Of course, there's some companies within the healthcare sector I think will actually suffer. Yeah, Henry says solar. Absolutely. I think the solar is going to be a big one. All right. Now, what if another party wins? The other party, libertarians. Yeah, we get the Green Party. Let's be honest, there's no way that's going to happen. We live in a system where it's going to be one or the other, and if one party even gets close, it's just not going to happen. So let's be honest. So we've got basically Democrats and Republicans. Those are kind of the major breakdowns. Keep in mind, it's not just the party that wins, it's what happens when that party wins. Of course, what are the other major considerations? It's not just about the president, right? It's the Senate, House of Representatives, Congress, that stuff. Those parties are also critical in helping those decisions being passed through about infrastructure, about transportation, et cetera. So this is a giant mess, if you will, this election. But what it will do is create a ton of volatility in 2020. All right. Next one, we talked about I briefly mentioned bond bubble. Let's talk about that bond bubble because I think that this is a very, very big one. My good friend Darren Komodo talks about this in his market timing events. And man, it's funny. You see his eyes turn into saucers when he brings this one up because he's legitimately scared about this one. And I think we have the right to be. John O'Donnell, one of our favorites here at Online Trading Academy, you can see him on Power Trading Radio, says that the mother's milk of capital is the credit market. Well, that's the bond markets. It's credit, right? You're lending out money. So take a peek at some charts here. This is the 10-year note. We could look at the ZN if you're futures traders want to bring that one up. This goes all the way back to 2001. And while this may not mean a lot to those of you who aren't traders and haven't looked at charts, you're looking at something that should remain rather constant and fluid and have a nice, even move to it. You can see a lot of chop here, but you also see it's really near all-time highs. This is important because of what's happening around the world. We are one of the few markets in the world that offer a positive yield. What does that mean? That means that I can buy a $1,000 bond. Basically, I'm loaning money to whoever I bought that bond from. So let's say I'm buying it from the U.S. government in the case of this 10-year treasury or 10-year note. So I buy it, pay $1,000. I'm going to get a rate of interest paid to me when I buy that bond. So that's a positive number. And you would think that if I'm going to loan somebody money, I should be receiving something for that opportunity cost of me locking up and committing my money to you. Well, a lot of the world right now, and you'll see this here in just a second, has negative yields. So what's happening is those countries with negative yields are basically saying if you buy a bond from your government, you're going to get less money than what you bought it for. So if you paid $1,000, you get like $950 back at the end of the term. That just seems ridiculous. Why would you ever do that? So what's happening is you're starting to see more of that money come to the United States because we have positive yields. Why would you park it negative? What does that do? That drives up the prices of these bonds, which means yields will get pushed down, getting us closer to negative. Now, in talking about negative yields, take a peek at this one. This is compiled by Bloomberg, and it's really scary. What I want you to focus on is the left-hand side of this chart. From 2012 to 2014, there was almost no negative yielding bonds around the world. There's almost none, zero. And all of a sudden, in 2015-16, something dramatically changed. Notice this big spike. We were hitting upwards of $17 trillion of negative yield bonds. Now you have to ask yourself, why is this important? Well, who cares? Negative yield, positive yield, big deal. Because a market functions where there's a value to money. And if you lend that money to somebody, they should pay you for that privilege of borrowing it, right? That's interest. What it also does is it helps economies. So if a country or a government is showing negative interest rates, negative yielding bonds, they are punishing savers. They're punishing people by parking their money. So what they're trying to do is forcing people to go out and take that cash and instead of park it and gain interest or lose interest, buy something, spend. It's meant to be a global stimulus, encourage you to not save your money, spend it because they want the economic growth and production. So let's look around the world here and find out who's doing it. Kind of interesting for those of you who are focusing on America saying, well, we've got a bunch of, we're in bad shape. Well, $332 billion of negative yield bonds are in the U.S. What's very interesting about this chart is look at 8.7 trillion for Europe, and it's pretty spread out over in Europe. Asia, it's all Japan. Of course, they're doing negative 0.1%. So that's a major one is the Japanese market at 7.3 trillion. And then you have international. The point is, if these countries, Asia and Europe, are using negative yield bonds to impact and influence their economy and help stimulate growth by punishing savers, don't you think that eventually America is going to want to catch up and play that game as well? So it's really interesting. You heard Alan Greenspan also make the comment that, zero is just a number. It is. We think in our heads that we're not going to go negative, right? Why would we do that? Because that's what they're doing to help stimulate the markets. Now, as we get more and more people buying U.S. treasuries or U.S. bonds because that positive yield, what that does is that pushes the price of those bonds up. They're chasing that bond bubble and inflating it, which is what we've seen, but the yields will be going down. Now, fortunately, over the past few months, we've actually seen a little bit of stability there. It hasn't, those bond prices haven't continued to skyrocket, but if we see this picture continue where foreign governments and foreign sovereign governments and businesses are doing negative yield bonds, that could punish us, and all of a sudden we might start to go negative too. Something to keep an eye on. Now, the central bank battle. This is an interesting one. We already looked at the U.S., right? We've been flatlined for a long time. We started raising rates because that's what we really should be doing, especially when our market's up over 350%. You should be raising rates to maybe slow that baby down a little bit. But you can see all of a sudden we've pulled back. Why is that? Why have we started to cut back here? Well, it's because these other countries, here's the UK. The UK obviously had aggressive cuts as well. They right now are sitting about 0.75. You look at the euro. The euro is at 0. Here is the Swedish krona, negative 0.25. And then, of course, you have Switzerland, which has got the LIBOR rate. If your mortgage is pegged to the LIBOR, you're a happy camper, is negative 0.75. So you see what's wrong with this picture. This is a great illustration of maybe one of those moments where you go, uh-oh, did we make a little bit of a mistake here? Notice nobody else in the world is raising their rates. You saw back in 2018 that the UK did, but they're stuck, and I don't see them doing anything until Brexit's resolved. What's interesting is these are all flatline and sideways. We were doing the right thing by raising rates. That's what we should have done. When a market looks like this, you should slow it down a little bit, because when you raise rates, it gives you the room to cut back and maybe, I hate to use the word, manipulate your currency again. All of a sudden, we had this uh-oh moment where we had 3 rate cuts in 2019. I don't think any of us really saw a huge market downturn. Did anybody see a huge market crash in 2019? No. We had a hell of a year. It was a great year from end-of-year performance results. So this, to me, is basically a little bit of a pause. I don't see this continuing down any further. I actually think you'll probably start to see it raise back up. But if these guys down here, UK, Euro, Sweden, Switzerland, and other countries, don't raise their rates, if they stay here, what's happening? They're giving themselves an unfair competitive advantage in the global economy. Why? Because they're, again, forcing their consumers to spend. So this is something to keep a picture, an eye on, is what's going on with these rates. My assumption would be that they're not going to change. Why would they? If it's not hurting them, then stay the course. And that could impact our rate decisions in 2020 and beyond. All right, so that was your bond market bubble. The major one, and it's hard to put which one of these is more significant than others. I know we've got a bunch of different opinions out here from different people. Sorry, Kevin. He says, I hate that I have to leave. Sorry, you can watch it later. Good to have you with us. Let's go to the currency war, right? And I know it's got a picture of China. Let's be honest, the currency war is not just about China. It's about almost every country out there. And you'll see why here in just a second. So as we dive into this, we have to understand, why is a weak currency good for an economy? It's really, really important. So let's take a basic example. Let's go and look at, let's say, the euro, right? So, the euro is going to fluctuate in price. You see it bouncing around here. And at this moment in time, 1 euro equals $1. Okay, so it's 1 to 1. No big deal there. But over time, let's say that euro increases and it starts to move up, and all of a sudden now it's 2 to 1. Okay, well, what's the big deal? Well, maybe I can help explain this by breaking it down to a very simple concept. Many of you watching this right now have an addiction. That's right, you're addicted. You might have a little mug next to you, looks just like this. It's got a cup of Joe in it. Coffee. We all love coffee, right? So let's break it down to a coffee example. If I use the example of coffee, and coffee is served around the world, and we'll say that in Europe, this cup of coffee is €1. And I'm using basic numbers just to keep it easy. Let's say this cup of coffee, and that's a giant, this is more than a 20 at Starbucks, this is like a 400, is €1, right? Well, if in the US that cup of coffee is $1, right? €1 is $1. But if the euro is now 2 to 1, this cup of coffee costs a European only 50 cents. The point is, by having a strong currency for the euro, those Europeans can come to America and buy more of our goods and services. So in there, let's say I'm from Germany, right? I'm from Stuttgart. I'm going to go to America for vacation. And I go to my local coffee shop here in Irvine, California. And back home, it was €1. I look over here, it says $1. I'm going, great, because my euro bought me $2. So I can drink twice as much coffee. I know it's this basic example, but look at it in a bigger picture. If I'm a foreigner and I'm the German guy and I'm looking over here and saying, wow, I'm going to go buy some stuff in America because I can now buy twice as much, right? What if I want to go buy a new car? I want to go buy a Ford F-150, fully loaded Raptor, right? $80,000 car. What's that going to cost me? 40,000 euros. So all of a sudden I can make more purchases. I can consume more in other countries. So when it says here, why is a weak currency good? Remember, this is a double-edged sword. It's good for European consumers who are traveling abroad and buying international goods and services. It's not good for European community. Why? Because now the European community is not going to sell its own goods and services as much because they're expensive. These consumers are going to go buy what they can get more of. For the US in this equation, is it good or bad? Well, if you're a US, if let's say I'm in Irvine, California, and I want to go over to Europe and buy a cup of coffee, this sucks. Because that coffee now costs me $2, right? However, as an exporter, if I'm an American company exporting goods and services, this is what we need. We need a weak US dollar. Why? Because now people will buy more of my goods and services. They'll buy more of my product. So we always have this internal currency war going on of trying to weaken our currencies so that our exports become greater. And right now our dollar has been rising actually, which is not helping exports. And I'll show you here when we get to the trade war portion why that's important. So just keep that in mind. A weak dollar is good and bad. It's great if your currency is weak for exporters, for domestic companies that might not be as good. Think if you're a European producer, right? I'm a European producer of high-end camera equipment, right? I don't know, because Zeiss, I think they're European. For an American to now buy my product, in this scenario, costs twice as much. So if I'm a consumer, I'm an American looking to buy a Zeiss camera lens, I'm probably not going to buy it. I'm going to try to find it somewhere else or maybe buy a different product where I can get more bang for my buck. Unless you just absolutely have to have that one and you're willing to pay double. That's the point. All right. Let's go to our final one here. Trade war. And by the way, that was just a European example. Let me go back, actually. I want to go back to this one, just so we can keep that currency war up there. There is something very interesting going on right now that you might want to keep an eye on, and that is that China is issuing debt denominated in US dollars. And you're like, well, how can they do that? Aren't they China? Don't they have to use the yuan? No, they're issuing debt in US dollars. And the belief, this is amazing. It's brilliance on the part of the Chinese. Because you hear Donald Trump saying, we need a weak dollar. I want a weak dollar. He's pushing Mnuchin to manipulate currency and make it even weaker. By cutting rates, it makes our dollar less attractive. The higher the interest rates, that Fed funds rate, the higher it gets, the more attractive dollars become. Why? Because if you're a Forex trader, and all of a sudden our US dollar is at, let's say, 2.5%, which it was in 2018, I could buy US dollars and get 2.5% annualized. I could buy USD JPY and make 2.6% because JPY is negative 0.1%. So we can play these currencies this way. Now, if the US dollar is at 2.5 and all of a sudden we start cutting rates and it's now 2, now it's 1.75. If we keep cutting, it becomes less attractive for foreign investors to buy US dollars. So there's currency manipulation going on even with the Fed funds rate on how attractive our dollars are. So what China is doing is making this bet. They're saying, okay, you want to weaken your currency? You're going to, and this is China talking to America, you're going to start a currency war and you're going to manipulate your US dollar like you've been telling the Mnuchin and the Fed to cut rates and cut rates and cut rates so we have a weak dollar? Okay, if you're going to do that, then what we're going to do is we're going to issue our debt in US dollars. So as you continue to force your currency weaker, we'll buy those dollars back later at a cheaper price, and we win. So what a brilliant move by the Chinese to hedge the bet here and kind of show their hand and say, okay, go. Lower U.S. dollar rates. Go for it. We're going to issue our debt in dollars. So this is a part of that currency war as well, which is developing as we speak. All right, let's go to the final one here, trade war. Oh, this is getting better and better and better. Let's see, real quick, see if I have any questions. Larger profits is great for the Dems. They can steal more of your money. Well, you know, it taxes. You know, it's kind of interesting. If we look at that picture from earlier, or actually, I wish I put it in the presentation today, showing that the Democratic Party annualizes 10% per year, and you're like, well, I'm paying more in taxes. Well, if you put that money in the market, you're making 10% per year. It offsets a lot of taxes, I'll tell you that. All right, the trade war. Boy, this is a fun one, and it keeps escalating. This is the reason you're seeing the markets today have a nice little rally. Why? Because President Trump says, the trade war is doing good. Then on Friday, we had hit a snag. It's the ultimate tool of market manipulation, the ultimate tool. So let's real quickly take a peek at the trade war and what it means. For many of you, you look at this picture and you're going, okay, products impacted by tariffs. We're looking at agriculture, we're looking at technology and apparel, right? It seems so basic when you look at just these three assets. And I believe, personally, that the media has done a decent job of keeping it very vague and saying, look, it's not really impacting us much. You don't see the price pinch. But if you go to the U.S. Trade Department, I actually pulled these lines from USA Today because they took it from the trade sheets, but I pulled them up. And you're talking page after page after page of different things. And it's so specific, like haddock, which is a fish. Okay, we're going to impose tariffs on haddock, but not the livers, the eyes, or the gills of the fish. Like, what is going on here? So I wanted to show you this one real quick, and it's going to be a lengthy one. If you don't feel that this trade war is impacting you, here are items that have tariffs on them currently. This should blow your mind. I don't care where you are, where you live, ethnicity, background, religious preference, vegan, whatever. Something in this list is hitting you. You've got cocoa powder, chocolate, that's easy. If you got live animals, camels. You got camels being taxed with tariffs. Whales, dolphins, foxes, reptiles. I mean, the list is ridiculous. And here's what's different from this. This is stuff that's already in place. As of Monday morning, if we don't have an agreement with China on December 15th, we're going to see a whole new list of stuff show up, which is impactful for us. Telephones for cellular networks, video game consoles, LED lamps. Isn't it convenient that all of these items that you see on this list, or a lot of them, seem to be rather popular around the holiday times, meaning go and buy more stuff? My cynicism tells me this, that this is a great ploy. Yeah, Dwayne says, not baby gear. They're getting baby gear too. They're getting you everywhere. My cynicism tells me this, that this is a giant ploy to get everyone freaked out to buy stuff before these tariffs hit. So, go buy your telephones. Go buy your video game consoles. Go buy your instant print cameras. Go buy, consume. Because if you don't buy today, it's going to be 15% more tomorrow. I feel like it's this almost fear-mongering with the trade war. And, you know, as a political move, it's kind of brilliant. Because all he has to do at a certain point is go, all right, we resolved. Trade war's over. Okay? So, I wanted to show you that one as just a basic, here's what's really being impacted. And by the way, if you want to celebrate this stuff, you better get your confetti today, because confetti, as you can see on this list, as of Monday, will have a 15% tariff on it. So those little pieces of paper that we buy from China, more expensive on Monday. All right, why is this important? Take a peek at this graphic here, because this really does speak volumes. In our trade war, what I'm going to do is go back and show you a couple of different numbers. This goes back to 2017. I pulled these figures from the U.S. Trade Department. We imported from China $506 billion worth of goods and services. And of course, we don't know whether that's good or bad. We need a reference point. So if we import 506, I mean, it would be nice if we exported 506, right? Well, no. We exported 130 billion. Okay, so, you know, I guess historically we need to see what these trends are. But I just wanted to put these numbers here to show you the relationship. And right now, we have about a 3.8, or in 2017, we had about a 3.89 to 1 ratio, meaning we import 3.89 goods and services for every one that we export to China. Now, of course, we would all say, well, that's not fair, and I guess that's the argument that our administration is making. That's not for me to decide. What I wanted to look at is, are the actions that are being taken to help equalize this having any effect? So let's look at the numbers. Remember, I want you to keep an eye, you might even write them down. We had $506 billion worth of imports, $130 billion worth of exports. We started this trade war in 2018 early, so it should be getting better, right? Well, here's the numbers for 2018. Remember, we went from 530 or 520? 520 to 539. So we've increased our imports from China by $19 billion. Clearly, the trade war and tariff stuff is not working. Now, let's go to our exports. We're at 120. So we're importing more and we're exporting less. There's a great movie called Planes, Trains, and Automobiles where John Candy is yelling out the window at a passing car. He's going, "You're going the wrong way." Yeah, we are too. It's not working at this point. Now, maybe in the long run it will. Now, here's why this is such an important part for 2020 and beyond. And I think this is why it's so mission critical that this is done right. If we can shift these numbers a little bit in our favor, I think we'd all agree that this could have a huge impact. Because right now, we went from 3.89 to 1 to 4.49 to 1 ratio. That's the opposite direction I think we intended to go. So what if these numbers did shift? What if there was some agreement where we go from $539 billion worth of imports to, let's say, throw me a number up there, how about 439? So we drop $100 billion worth of imports. Now that obviously would take time to get there, and I don't think it'll happen in 2020, but I'm just throwing a hypothetical what if. I want you guys to just take a step back and think, what would happen if this happened? And what if our exports to China didn't drop to 120, but they actually increased to 190 billion? All of a sudden that ratio, which is currently at 4.49, would drop to 2.31. With those numbers in place, the U.S. economy would be booming. It would be doing much, much better. And this, I believe, is an extreme example. I may have tailored these numbers a little bit too much as a forecast. And maybe by 2025, 2030, we get to these types of numbers. But I think the point I'm trying to make is if there is a subtle shift in the amount that we import, and that declines, and the amount that we export increases, all of a sudden that little bit of shift in balance could have huge impacts for our equity markets. And I think that that's part of the optimism you're seeing with this is we're asking for the world, but at the end of it we might just get to small little improvement. And a small little improvement with this trade imbalance that we've had for the longest time would have a significant impact on our markets. It could be one of those tailwinds that just vaults this market into ballistic all-time highs. Now, of course, that's not going to happen overnight. You know, we're already talking about phase one, and we still can't agree on phase one. That we'll see what happens on Monday or Sunday night going into Monday, which of course will be your market mover for Monday. But it is this ongoing thing. It's going to happen all through 2020. If we do get a phase one on this trade deal, you're going to have a phase two, a phase three, and it will be this chess game that goes back and forth and, of course, keeps the markets uncertain. The biggest driver for market activities in 2020 will be just that, uncertainty. Uncertainty about the presidential election. Uncertainty about the bond market. Uncertainty about the currency war and who's going to do what steps to manipulate their currency. And finally, uncertainty of that trade war. There are a ton of things out there which could really, really vault this market exponentially higher or potentially even crash it down. It's interesting. I am blessed because I work in an environment where I'm surrounded by great, great traders who've done this for many, many years. And even as great traders, you would think that there's a general consensus that we all kind of think similarly. That's not true. I have a couple of trader friends here, I actually interviewed them on Power Trading Radio, that believe we're going to see huge moves up in 2020 to the tune of 20 to 30%. I also, on the extreme side, have one trader friend who I hold in the highest regard, says he expects, and I can't believe I'm actually going to say this, an 82% decline between July and the election. We could go either way. The bottom line is all about preparedness, understanding what markets are doing, how to react to those, having a plan in place. And I know most of you guys here are Online Trading Academy graduates, so I know that you understand this, but many of you might not be. And if you're not aware of how to deal with this or have a system in place, and of course we always talk about our core strategy, but there's simple rules that we should be putting in place for our 401ks, our IRAs, if you are just a long-term investor. Our more active traders also have rules in place to capitalize on this. But you know, if we did see an 82% decline, how many of you would be caught off guard? How many of you all of a sudden be going, oh, I just lost all my retirement? That's the pain point that nobody wants to endure. Everybody wants to endure that 20, 30, 40, 50% up move in the markets. It's that down move, that black swan. And the longer we keep going in this unbelievably bull market that we've been in, the probability of that black swan rising gets bigger and bigger and bigger. And part of me, even though I think 82% decline is just absurd, I don't think that's going to happen. Could we see a 30% decline in a very short period of time, a month? I think we could. I think we're due for a flash crash, something very, very big. Let's see. Somebody says Merlin for Fed chair. Yeah, no, I don't want that kind of responsibility. On the trading side, goods and services, that's going to be both, Nick, on both those. No, I'm not going to run for Fed chair, guys. Although, wouldn't it be great to make that much money to come out every 8 weeks and be like, I'm reading the same script from last week and everybody's scrutinizing the script to see which 2 letters I changed? Yeah, that's awesome. Let me get a 6-figure salary and I get to do speeches after and write a book and get paid for the rest of my life. Yeah, that's pretty awesome. Maybe I will go for Fed chief. All right, that is it for our top 4 components for 2020. Obviously, guys, there's way more than what I've just conveyed here, but trying to break it all down into 4 big components is kind of challenging, right? I've been doing this a long time, trading these markets since 1996, and I wish I would pay closer attention to these things. I kind of was shooting from the hip back then and just didn't really pay much attention to the macro picture. It's the macro picture which gives us those big swings in price, which of course are the ones that set you up for your entire career or life with your portfolios. So hopefully, we've given you a little bit of information here, maybe a little food for thought, something to chew on and think about as you go into the weekend. Hopefully you enjoyed that. If you'd like to know more, or if you would like to know more about using options or futures or forex or commodities and how to capitalize on some of these market turns which are going to be happening both up and down, I would encourage you to click that link or just type in otwebinar.com. Go there, visit that one. You can register for a free workshop where we talk about market timing, we talk about core strategy and different principles, how these markets truly work so you can trade and invest more like an institutional trader and understand how this market truly works. That will do it for our webinar for today, everybody. Thank you so much for your participation. We'll see you next time. Take care.